All right, here we are. So before we do anything else tonight, what we need to do is work on the chapter 16 and 17 problem sets. So we'll do that first, and then we can get back to where we were. So first, let me get them open. All right, one more. All right, so we might as well start with 16. So we're looking at a PPP question. This is actually related to the Big Mac index. That's really what this is all about. Okay, so let's get this going. Now, how exactly are we supposed to fill in this box? So first things first, we have exchange rates between the United States dollar and the Argentine peso, the Brazilian real, the Chilean peso, and the Mexican peso. Now, of course, as we know, we don't expect PPP to actually hold, but what we do want to know is how do we figure out whether it holds or not? Okay, so in the first two columns, you're given the Big Mac price in the local currency. So for example, it costs $2.42 in the US. It costs 2.5 Argentine pesos, 2.9 Brazilian real, 1,200 Chilean pesos, and 1490 Mexican pesos. Now, the exchange rate here is so many units of foreign currency per dollar. So at this point in time, the Argentine peso was actually pegged to the US dollar at a rate of 1-to-1. So each Argentine peso can buy $1. It takes 1.06 Brazilian reals to buy a single US dollar, 417 Chilean pesos to buy $1, and finally 7.9 Mexican pesos to buy $1. So in column 3, we're trying to figure out the Big Mac price in dollars. So let's look at this first one, for example. Well, this one will be straightforward. Let's look at this one first, the Brazilian real. You'll see what I mean in a second. So how exactly would this work? All right, so let's say for Brazil, we know that it takes actually, let me do this by hand. For Brazil, we know in column 1 that it takes 2.97 reals. I'll use R to represent that, to buy one Big Mac. Okay. We also know that the actual exchange rate is 1.06 reals per dollar. So what I ultimately need is dollars per Big Mac in Brazil. So what do I have to do? I've got to figure out a way to arrange these in such a way that the reals cancel out. So let's try this one. Let's start by trying 2.97 reals per Mac, and then we'll turn around and divide that by 1.06 reals per dollar. Now, algebraically, this is the equivalent of multiplying by the inverse. So here the R's drop out. So the ratio of 2.97 to 1.06 is approximately 2.802 dollars per Mac in Brazil. So we come up here and we fill this in as 2.802, and that means real. No, I was right the first time. Dollars per Big Mac, but in Brazil. So if I went to Brazil and I traded all my dollars if I trade my reais for dollars, it should cost me $2.80.2, or the equivalent of it, to buy a Big Mac in Brazil, compared to the price in the United States, which is $2.42. So that means that PPP does not hold, because if PPP really held, this entire column would all be equal to 2.42. But that's not happening. Already we can see there's a problem. So let's see. Let me split the screen so we can see everything. So why don't we try Argentina now? The thing about Argentina is it's a very simple case because of the peg of the peso to the dollar on a one-to-one basis. So what do we know about Argentina? Well, we know that it takes 2.5 pesos to buy a Big Mac. And it also takes one peso to buy a dollar. So why don't I do the same thing I did with Brazil? 2.50 pesos per Mac will be divided by 1 peso per dollar, which equals 2.50 per Mac, 2.50 pesos per Mac times $1 per peso. So the pesos drop out. That means in Argentina, a Big Mac costs the equivalent of $2.50, after, of course, going through the exchange rate. So this one is 2.50. It's still not the same as it should be, because it should be 2.42. All right, now let's look at Chile. What's going on in Chile? We know two things. Number one, it costs 1,200 pesos to buy a Big Mac. And at the same time, that was 417 pesos per dollar. So the ratio of those two is equal to 1,200 pesos per Mac times dollars per $1 per 417 pesos. The pesos drop out, and we're left with that ratio is equal to 2.878 dollars per Big Mac in Chile. So we have 2.878. And then finally, in Mexico, what do we know about Mexico? Two pieces of information. Okay. We know that it costs 14.9 pesos to buy a Big Mac. Okay. We also know that it costs 7.90 pesos to buy a dollar. So therefore, 14.90 pesos per dollar, pesos per Mac, is divided by 7.90 pesos per dollar. So once again, algebraically, this is the equivalent of multiplying this by $1 per 7.90 pesos. The pesos drop out, and that ratio turns out to be 1.886 dollars per Big Mac in Mexico. So this is the only country where the Big Mac is actually cheaper than in the United States. All right, now that's column 3. Now the implied PPP exchange rate, what would that be? All right, so for these, what you have to do, well, let's try it. Let's start with Argentina. Okay, so here's what you have to do. I guess we could start with Argentina. What we're aiming for here is the price of the Big Mac in the local currency and there you divide by the dollar price of the Big Mac. So in other words, in each of these cases, we'll be dividing by 242 per Mac. Now, if you notice, this time is the max we want to drop out. So that ratio, 2.50p over $2.42, works out to be 1.033 pesos per dollar. So this is what the exchange rate should be if PPP was true. All right, so you can see it's not off that much, but it is off. And then we move on to Brazil. And so in Brazil, we take the cost of buying a Big Mac in Brazil, and we divide that by 242 per Mac in the United States. So these drop out, and that turns out to be 1.227 real per dollar, as opposed to the actual exchange rate in column 2, which is 1.06. So you can see, once again, PPP is off a bit. And now we go to Chile. So once again, we need the Chilean price of the Big Mac. Which is, as you can see, 1,200. We're going to divide that by 242 per Mac. Algebraically, this is the same thing as 1,200 pesos per Mac times max per dollar. The max drop out, and that works out to be 495.868 pesos per dollar. Now, compare that with the actual exchange rate in the second column of 417. You can see that one's off by quite a bit. Oops. And then finally, the Mexican peso. Let's do Mexico now. So we take the 1490 pesos per Mac, and again divided by the US price. Algebraically, this is the same thing as 14.90 pesos per Mac times 1 Mac per 242. Anyway, that turns out to be approximately 6.157 pesos per dollar. And again, it's really not that close to the actual exchange rate. It's quite a bit off. All right, now, In this last column, we're trying to figure out whether each of these currencies is over or undervalued compared to PPP. So now this is where it gets interesting. Let's start with the peso, Argentina, that is. We're trying to calculate the percentage difference between the actual exchange rate and that implied by PPP. So you're going to take in each case the PPP exchange rate minus the actual exchange rate. And then we're going to divide all of that by the actual exchange rate. All right, so for Argentina, let's see, let's go right there. Okay, so we've got 1.033 pesos per dollar minus 1 over 1. And that worked out to be 0.00, wait a minute, 0.0331, approximately 3.31%. So if you look at it carefully, you'll see that according to this chart, anytime that this number is positive, then according to PPP, this currency is overvalued in the market. Why? Because if you look at this first one, according to this, PPP says that it should take 1.033 pesos to buy a dollar, but you only have to pay $1 in the real world to buy a dollar. Therefore, the peso is too strong as far as PPP is concerned. We say that it is overvalued according to PPP. All right, so we'll do the exact same thing for Brazil. All right, let's see what that works out to. So remember, what you're doing is you're taking the implied exchange rate, according to PPP, that is. You're subtracting what it actually is in the real world, and then dividing it by the actual real world exchange rate. All right, so that's going to give us 15.78. Okay, well, that's a pretty significant difference. Now, how about Chile? Chile is probably even more inaccurate according to PPP. So you've got Chile. Implied is 495.868 pesos per dollar compared to the actual exchange rate of 417. And that turns out to be 18.91%. All right, finally, we have one more. Let's do Mexico. All right, so the implied 6.157 pesos per dollar minus the actual 7.9. Divided by 7.9. Now, this is the only one in the group that's negative. It's negative 0.2206, which is negative 22.06%. So according to PPP, this is the only currency in this group that's undervalued. It should be selling, or it should be more expensive in terms of the dollar, but instead it's too cheap. Now, when we did this with the real world data, you might recall that we went to their website, only like 2 currencies were undervalued, and the rest were pretty seriously overvalued, according to PPP. In fact, most of the numbers were much, much larger than these numbers. These look pretty big, but they're really not. I mean, let's go back to the chart. The highest one is 22. If we look back at the Economist website, they're going to show us, yeah, look at this, watch. Here we go. Well, maybe there's a lot. Now look at these. It's so funny. It's just the opposite of this. Mostly these are over. Here, only 3 of them are overvalued. The rest of these are under by quite a lot. Look at these numbers. Yeah, look at that. It goes as high as 68.7% for Lebanon. Which means that as far as PPP is concerned, the dollar is too strong relative to its purchasing power. But you can see the key to the whole thing is it's really not that close. And of course, that's because it's a Big Mac, which is not a tradable good. If we tried something different, like, some standard commodity like wheat, well, even wheat, it's kind of maybe, but this is definitely a case where you would not expect PPP to hold because there's no way of arbitraging off of these price differences. All right, so finally that's over. Now let's take a look at some of these other ones. So in this one, silver sells for $10 per ounce in the US. And in the UK, £4 per ounce. But since the exchange rate is $2 a pound, oh, I forgot to write it in here. That implies that this is $8 a pound, or an ounce, sorry, an ounce. So that means the silver is undervalued in the UK. Overpriced in the US. Arbitrage profits can be earned by buying silver in the UK and selling it in the US. And so that's, of course, the whole idea is you want to buy something where it's too cheap and sell it where it's too expensive. And that's how you make your money. Excellent. All right. Now let's look at this one. The price level in the US is 100. It's 55 in the UK, all right? So P is 100, P star is 55. Now remember, the PPP exchange rate is E equals P over P star, which is 100 over 55, which implies $1.8182 per pound. And that one's done. So if PPP was real, you'd expect the exchange rate to be $1.8182. Now, if the actual exchange rate is $2 a pound, then you would say the pound is considered to be overvalued relative to the pound, the dollar, sorry, because it takes $2 to buy 1 pound, when according to PPP, it should only take $1.8182. And that's what they mean by over or undervalued. Okay, so what factors contribute to violations of PPP? There's 2 or 3. The existence of non-traded goods and services and trade barriers. That's probably good enough. That's what really does it. Okay, now this is the relative PPP condition. So you might recall that relative PPP looks like this. The percentage change in E equals a percentage change in P minus a percentage change in P star. And this can be interpreted as US inflation. And this can be interpreted as UK inflation. All right, now, so what we need to do is first calculate the implied percentage change. US inflation is 2%, and UK is 5%. So this is just saying that the dollar should appreciate by 3% against the pound. And so if it does, given that it's currently 3%, then you would just say, all right, so in 1 year, the dollar should be selling for. So it's $2 per pound minus 3%. Remember, minus because it's appreciating. So that's $2 per pound minus 3 cents per pound. Sorry. Oh, what happened there? Okay, so it's 2% minus times 3%. So it's $2 minus 6 cents per pound equals $1.94 per pound, if nothing else changes. Okay, so 3% of $2 is 6 cents. We subtract that, and we end up with an implied or a predicted US dollar exchange rate to the dollar pound exchange rate of $1.94 per pound. All right. All right, so that's done. Now, in part 3, we're looking at real exchange rates. So what do we know here? The US goods, the basket of US goods costs 100. The UK is 90 pounds. I guess we don't need the currency here. 90. And the exchange rate is $2 per pound. All right, so we remember, I hope, that the definition of the real exchange rate, Q equals E P star over P, which is 2 times 90, all divided by 100. So that's 1.880 US baskets per UK basket. So, oh yes, how can this be interpreted? It takes a US citizen, it would take a US citizen 1.80 US baskets of goods to buy one UK basket of goods. Now, if the price of a basket of the UK goods rises to 100 pounds, what's the new real exchange rate? So really all we have to do is take this and update it. So now all of a sudden both price levels are 100. So suddenly it becomes 2 US baskets per UK basket, up from $1.80. So that means the dollar must have gotten weaker. So the pound has experienced a real appreciation, even though it didn't actually experience a nominal depreciation or appreciation. In real terms, the pound has gotten stronger because, again, it takes more US baskets to buy one UK basket. That implies, of course, that the dollar has experienced a real depreciation. And as a result, the US US goods and services have become more competitive in world markets. In other words, US exports will decrease, increase, and US imports will decrease. Okay. All right, so that was done. Wow, look at all those calculations. All right, now the next one probably has more graphs in it. All right, so let's get this saved and get out of here. All right, yes. Well, yes and no. There are definitely some graphs on here. So let's take a look at them. So number one, what is disposable income? This is defined as real GNP minus taxes. And it's written in the notes as YD equals Y minus T. What does this do to the current account balance? More disposable income increases US imports, but has no effect on US exports. Therefore, the current account balance worsens. If the dollar appreciates in real terms, what is the impact in the U.S. current account balance? Well, with a stronger dollar, exports will fall while imports will rise. Therefore, the U.S. current account balance will worsen. Okay. What impact does the real exchange rate have on investment spending? Now, this is an assumption that we're making in the book, but the investment spending is assumed to be independent of the real exchange rate. All right. Now, what effect does a tax reduction have on the DD curve? Since the tax reduction stimulates the economy, there will be more output at every level of the exchange rate. As a result, the DD curve shifts to the right. All right, shifts to the right because it is being stimulated. Now, if you've forgotten, we can go back to chapter 17 and review some of these graphs. Which we probably should do anyway. Here we go. Oh, wait a minute. Here we are. That's AA. So DD is the one that involves aggregate demand, as it's called. So it's upward sloping. And the following factors cause it to shift to the right. Tax cuts. Right there. Yep, there it is, right on top. Would also increase in government spending and investment spending. So DD shifts to the right. Remember, the DD curve has E on the vertical axis and Y on the horizontal axis. Okay, that's all we really need. What effect does an increase in government spending have on the DD curve? It's the same thing. We saw that in the slides. Since an increase in government spending stimulates the economy, this will shift the DD curve to the right. We probably don't need to draw it again. So that's going to increase it to the right. G, how about monetary? Oh, okay, we better review this one. This one's a little trickier. The AA curve, of course, is downward sloping. So the question is, what's going to happen here? So if we increase the money supply, that will lower interest rates, which should stimulate the economy. So let's confirm that. There it is. Increase in the nominal money supply causes it, yes, to shift to the right. All right, very good. Then H, what effect does contractionary monetary policy in the UK have on the AA curve? Well, this should be just the opposite. Oh, I forgot to mention it here. An increase in the nominal money supply reduces interest rates and stimulates the economy. Therefore, the AA curve shifts to the right. All right, and that's what we're seeing here. But contractionary monetary policy in the UK will cause interest rates to rise in the UK, causing the dollar to weaken, which should stimulate US exports. Okay, so contractionary monetary higher, right, whoops, it was right there. Higher UK interest rates shift the curve to the right. Okay, as a result, the AA curve will shift to the right, just like in the previous one. All right. Now, using the AADD framework, show the impact of expansionary fiscal policy on the exchange rate and real GNP. Okay, so anything that stimulates the economy, as we've already seen, will result in a stronger economy, of course. So starting from point 1, we would expect that expansionary fiscal policy stimulates the economy. Whoops, I almost got the wrong one. That means the DD curve should shift to the right. And we'll end up with a stronger dollar and higher GDP or GNP. All right, so that's our graph. And of course, because expansionary fiscal policy increases what we call aggregate demand, shifting the DD curve to the right so that the dollar strengthens and GNP increases. Beautiful. That's it. Okay. Now we're going to consider the case of contractionary monetary policy. Now, contractionary means, remember too, AA is the one that's affected by monetary policy. So since contractionary monetary policy raises interest rates, the economy will slow. This is shown. Oh, but the dollar will get stronger. This is shown by a leftward shift of the AA curve. Okay, we'll just confirm that here. Contractionary or US rates going up, or we can think of it as US money supply going down, causes the curve to shift to the left. Exactly. All right, so of course it's just the opposite. So when AA shifts to the left, output is dropping, but the dollar got stronger. Okay, so that's that. All right, great. So those are both done. And now we can get back to where we were. which is in chapter 18, which is our discussion about fixed and floating exchange rates. All right, so let's go get that. Now, I think I may have saved a couple more videos for tonight. I have to go double check. But remember, we were talking about fixed and flexible exchange rates. And we looked at the case of Hong Kong, where exchange rates are fixed, and they have been for many years now. But most countries at this point in time have floating exchange rates. They both have their advantages and disadvantages, but for the most part, the reason for having fixed exchange rates is to reduce your inflation rate or your interest rates, and also to introduce some stability into your exchange rate, which for some countries can be very volatile. So let me go back and double check my list of videos. I'm pretty sure I saved at least one for this week. Yes. You know what I'd say? I found some interesting ones. I'd like to start by showing the Bretton Woods. Now, I know some of you might want to write about the Bretton Woods system for your paper. A lot of people have already written to tell me what they want to write about. And I'm not sure if everybody has, but if you were thinking about the Bretton Woods system, this is directly relevant to what we're talking about, because the Bretton Woods system was a system of fixed exchange rates between the US dollar and several of the largest European countries and Japan right after World War II. I think it was Japan. I'd have to double check. But right after World War II, the idea was to rebuild Western Europe, and the best way to do that was felt to is immediately reestablish trade relationships. And the best way to do that would be to eliminate all foreign exchange risk. It also meant that we could continue to have not a gold standard, but what's called a gold exchange standard, which means that international debts could still be settled by gold, even if gold did not circulate as money in the member countries. And the system worked well for a while, several years, but eventually it outlived its usefulness and it was abandoned in the early 70s. So why don't we start with this quick video about the Bretton Woods system, and then I've got a couple more interesting ones that I think you'll like. All right, hold on 1 minute. All right, let's check this thing out. After World War II, it was clear the world needed a new financial system. Wow. All right, well, that was pretty skimpy, I must say. You know what? Why don't we do I have access to another video here, which is a little bit more in depth. So why don't we check that out? It's partially just because this is interesting material, even if you don't write about it yourself. I think you would like to have more information about this, just because it is a very important part of economic history. So let me just fire this off to you right now. All right, let's look at this one. Okay. Now, this next one, now, since you mentioned it a couple of times, and this plays a major role in the Asian crisis, which I mentioned last week as one of your potential topics. I'd like to share this video about speculative attacks so we can see what are they and how they can lead to a currency crisis. So let me send this off to you. What happened? Here we are. All right, let's check this out. Speculative attacks. All right, so I did mention the Asian crisis, which is one of the topics that you might be interested in writing about. So they do have a nice short video about what happened during that crisis, and it has a lot to do with what we're seeing here because the countries involved had fixed exchange rates with respect to the dollar, and they were subjected to speculative attacks as they tried to maintain those exchange rates at their fixed levels. And ultimately, they were not successful, and it led to a lot of let's say, a lot of these economies were hurt very badly. And in fact, the World Bank had to lend them significant amounts of money to help rebuild those economies. So let's take a quick look at this one. Let's see. Hold on one second. And all right, hold on. So you might find this one interesting as well. All right, here we go. Let's check this. Let me send this to you, and we'll look at this. Okay, so I guess you're done with that one. So I want to show you one video now, switching topics. Again, this is something else that I thought somebody might be interested in for their paper. Um, Dollarization. Remember, we discussed this last time. We mentioned that some countries actually use the U.S. dollar as their own currency. They do not have one of their own. They just use dollars. Now, of course, this represents a lot of challenges to that country, but in some cases, it's worked extremely well. And one of those cases is actually Ecuador. In fact, they just recently saw the 20th anniversary of dollarization, and so far everything seems to be working out very well. In fact, I've actually met people from Ecuador who will agree that it worked out very well because the economy was really a shambles when this first happened, and since then they've been able to lower their interest rates and their inflation rates to levels that are much closer to the United States. And so, all right, let's take a look at this first video, which is an introduction to the story of dollarization in Ecuador. I think you'll find this interesting. Well, I didn't realize. I mean, that was kind of amateur. So, I mean, it looks like high school kids did that, but still, it contained a lot of useful information. And so it's not, the worst thing I've ever seen, but, it was a little clumsy, but I'm sure they got an A. But they did cover a lot of interesting points. The idea is that they have completely lost control of their own monetary policy, but it did help reduce their interest rates quite a bit. And also, it provides stability to their foreign exchange, which means that other countries won't be scared away from investing in Ecuador. And so, and a lot of the problems they were having were caused by fluctuations in oil prices. Their economy is very heavily dependent on oil. And so, at the time that they dollarized, oil prices were collapsing. And so, they were really in bad shape. They had a very high inflation rate, they had very, very high interest rates, and their revenues from oil were collapsing. So, this was a desperate attempt to salvage the economy, but it does seem to have worked very well. So, all right. Now, there's more here that I have to look at, but why don't we knock it off for a bit? I don't want to just spend the whole night watching videos, although they're certainly very good. But yeah, why don't we have our break right now? When we get back, maybe we'll watch one more video or one or two, and then we'll get back to the notes. Specifically, we were roughly halfway through chapter 18, and we're about to look at our discussion about currency crises and capital flight, just like what happened in the Asian crisis. So that worked out rather well. So, all right, let's stop for a bit. And when we get back, we'll get back into our discussion about capital flight and exchange rate crises and fixed exchange rates. So I'll see you all in a bit. All right, let's get back to it. So now this next one is about dollarization again, but this is sort of a retrospective about what's happened since then. Let's check this one out. Well, all right. Now there's just one more. I just want to show you. There's also one here about dollarization in Venezuela, which I'd like to look at, and now we can get back to the notes. Hold on 1 second. All right, hold on. Here we go. All right, let's check it out. All right. So now let's do some more. Whoops, hold on. Okay. All right. So this is where we left off with chapter 18. So 18, we just about started to talk about capital flight and balance of payments crises, which tie in nicely with the Asian crisis of 1997. So remember, this is against the backdrop of talking about fixed exchange rates. So a central bank's ability to maintain a fixed exchange rate depends on confidence. Okay, people have to believe that they mean what they say in order to take them seriously and to do business in that country and to invest in that country. And so confidence is a major component of this. If, on the other hand, if the country's currency is just weakening and the central bank needs to be continuously intervening, well, then that starts to cause people to wonder if this can last. And then they may decide to pull their funds out of the country, and that could cause the whole thing to collapse. And that has actually happened many times in the past. And that's because in order to keep propping up a weak domestic currency, the central bank has to sell off more and more of its foreign asset holdings. And of course, the problem with that is that eventually the central bank can run out. They can't run out of their own currency, but they can run out of foreign assets, foreign exchange. So if they have to keep propping up a progressively weaker currency, then eventually they'll have to give up when they run out of foreign exchange. So then, unfortunately, if they do have to give up the fixed exchange rate, usually what happens is once it starts to float, then the currency will usually experience a very sharp depreciation, which could mean that inflation could come back. Foreign goods are very expensive, that type of thing. So this is something that central banks would like to avoid if at all possible. Also, of course, it means investors in those countries will get their money out right away as soon as they can. And this is referred to as capital flight. Okay. So in other words, if you like, especially anybody who's invested in small third world countries, the minute something starts to go wrong, you can see a lot of capital flowing out of those countries back into safer countries like the United States. And once this gets started, it starts to take on a life of its own. And you'll see a lot of investors doing the same thing. And before you know it, this country has enormous interest rates and a lot of debt at the same time. So how do we explain this in terms of our graphs that we've been using? So imagine the following situation. We have let me make this a little bigger here. We've got a fixed exchange rate here called E1. And so what happens is, imagine a scenario where the initial equilibrium exchange rate is E1, and the central bank has committed to keep it fixed there. If investors start to have doubts about the central bank's ability to maintain the fixed exchange rate, their expectations rise from E1 to EE2. Okay, in other words, foreign investors become more pessimistic about the ability of this country to maintain its fixed exchange rate. So the return to the foreign currency curve shifts up and to the right. And the only way that the country can maintain the fixed exchange rate, in other words, the only way to keep it from depreciating is to raise their own rate of interest. Okay, so in other words, you see that from one, they went directly to two. And so what had to happen was, once investors start to become pessimistic, the return to the foreign currency curve shifts up. And so the domestic country has to respond by raising their own interest rates. Otherwise, you can see that E will change, and that's exactly what they're trying to avoid. The problem with that, of course, is that if they keep raising their domestic interest rate, it can start to really harm the domestic economy. Obviously, with higher interest rates, there'll be less consumer spending, there'll be less investment spending, and GNP is bound to start falling. So that's something that could be a real problem. Now, if expectations continue to move in that direction, you can see, well, we've got a real problem on our hands, that eventually our interest rates will become so high that they will actually do more damage to the economy than the fixed exchange rate is helping. And so in a lot of these situations, the bank eventually has to give up the fixed exchange rate. And unfortunately, when they do that, their own currency tends to weaken dramatically. And so they wind up with a great deal of inflation and higher import prices. A lot of problems start to result. So, but a lot of it has to do with confidence, okay? And that's why this EE term is so important when we're looking at the return to a foreign currency. That confidence is what prevents people from selling that currency and taking all their money home. Once that confidence is lost, it's hard to get it back. Okay, so yes, so in other words, now investors start to pull out their funds. The expected return of the foreign currency exceeds the domestic currency. The domestic government has to respond by raising their own rate of interest. And how do they do that? By selling foreign exchange assets. In other words, the way that they increase their interest rate is to reduce their own money supply by selling off some of their holdings of foreign exchange assets. So that's what the real problem is. Even if they are willing to keep letting their interest rate go up, they may not be able to, because they will eventually run out of foreign exchange assets. And then they have to give up the fixed exchange rate. Okay, and if this keeps going, eventually they'll just give up and say, listen, we don't want to destroy our own economy by raising rates through the roof. It's just not worth it. Okay. And now, why might investors lose confidence in the central bank? Well, what can happen is, what if the country continuously runs up enormous deficits, fiscal deficits, in other words, budget deficits? That could be a very bad sign of weakness, which could cause investors to lose confidence in that government. And the same thing starts to happen. Um, how about, other things can happen too if the country has a lot of inflation, if they have a lot of trade deficits, if there's strikes going on or political turmoil. There's a lot of reasons why investors in these countries can start to lose their confidence, and that can trigger a crisis just like this one. So why don't we look at this AADD framework under the assumption of fixed exchange rates. Now, with flexible exchange rates, both monetary and fiscal policy can stimulate the economy. But it turns out that with fixed exchange rates, central banks cannot conduct an independent monetary policy, although at the same time, it turns out that fiscal policy becomes more effective. So you'll see why in a second. So imagine that you've got a fixed exchange rate and your economy is sluggish. You need to do something about it. You decide to increase the money supply and lower interest rates. And so you're engaging in an open market purchase so that you can increase your money supply and lower interest rates. So the AA curve shifts to the right, which sounds like a good idea. So the domestic rate falls and the exchange rate weakens. All right, so we've seen this before. In fact, let me just sketch in here what that looks like. Let's say right here. So the AA curve moves to the right. And so you'd think that everybody would be happy. But you can see the exchange rate is depreciating, although the economy is strengthening as a result. Okay, so we have lower interest rates, we have a stronger economy, GNP goes up, but the currency gets weaker. Now there's the rub. The currency can't get weaker because we have a fixed exchange rate. So we have to do something. We have to take offsetting steps to strengthen it back to its fixed level. How do we do that? We sell off some of our foreign assets, which we've seen before, reduces the domestic money supply, and rates will go back to where they started out. But then, unfortunately, that means that the rate of interest and GNP will just simply return to their original levels. So let's see, there it is. Okay, so in other words, AA shifts to the right so that we end up here with a weaker dollar or weaker currency, although more output. But unfortunately, at that point, we can't allow the exchange rate to stay at E2. We're committed to keeping it at E1. The only way to do that is to sell foreign exchange assets, reduce the domestic money supply, raise the interest rate to its original level, and we're just right back where we started from. So because of that commitment to maintain the fixed exchange rate, you can see that monetary policy doesn't do any good because any steps we take have to be offset with our foreign exchange assets. Now, if the opposite case happens, the central bank wants to engage in contractionary monetary policy because they're worried about inflation. So they cut back on the money supply, they let interest rates go up, AA shifts to the left. Okay, and so everything works the way they expected. All right, so we go from here. Oh, whoops, wrong one. So you can see that the domestic currency gets stronger, but the economy slows down. But again, there's the problem. We're supposed to be keeping our exchange rate at E1. So this time, We have to buy foreign assets. We have to restore our domestic money supply to its original level to get E back to the correct level. So in other words, once again, the AA curve just simply winds up back where it started from, and nothing has changed now. So in other words, we can't do anything with monetary policy as long as we have a fixed exchange rate. On the other hand, what about fiscal policy? Now remember, that's the one that affects the DD curve. So if we decide to engage in expansionary fiscal policy to stimulate the economy, the DD curve shifts to the right, following either an increase in government spending or a tax cut. And so now this time, let's see, when we shift this to the right, so this is our expansionary fiscal policy. And you can see the dollar's getting stronger, or the domestic currency, whatever the case may be, and the economy is getting stronger as well. Which sounds great, but unfortunately now we've got to figure out a way to weaken the dollar or the domestic currency to get us back to the fixed exchange rate. So what do? Well, we buy up some foreign financial assets, which increases the money supply. It lowers interest rates, but guess what? That causes the AA curve to shift to the right. So this time we've got two movements. We originally started out by increasing the DD curve, but when we get down here, what's happening is the central bank buys foreign assets, US rates fall, and so the domestic currency depreciates. And as we've already seen, an increase in the domestic money supply causes this curve to shift to the right. So this is expansionary fiscal policy. And down here, this is the result of buying foreign assets. Okay, which increases the money supply, and that reduces interest rates. So one follows the other because we need to be always at E1. And so, but because of that, if you notice, if we did not have a fixed exchange rate, we would have wound up at 0.2, and income would have only increased from Y1 to Y2. But because we're required to maintain the fixed exchange rate, here's the interesting part: GNP actually goes up more than it would if we did not intervene in the foreign exchange market. So having the fixed exchange rate actually makes fiscal policy have a greater impact on GNP. Well, of course, we have to keep the exchange rate fixed. So that's why we say that fiscal policy is more effective under a fixed exchange rate regime than under a floating exchange rate regime. So the trade-off is we lose control of our monetary policy, but we have more powerful fiscal policy as a result. Kind of a nice benefit. Now, obviously, all this works in reverse if we're trying to engage in contractionary fiscal policy. Let me just quickly show you how that works. We start out here. And this is a result of selling foreign assets. And so the net effect is that we go from 1 to 2 to 3. At 3, we have a much lower GNP, but we do find ourselves back at the original exchange rate. So either way, in the case of expansionary fiscal policy, the curves shift further to the right than they would have. GNP increases by more. With contractionary, GNP decreases by more. All right, and one more thing I just want to mention here. Suppose that the central bank decides that the exchange rate that they've chosen is either too strong or too weak. If the exchange rate we picked is too strong, that means our exports are becoming too expensive to foreigners, and therefore unemployment is rising. If we chosen a rate that's too cheap, or too weak rather, then our imports are becoming more expensive, and inflation is becoming a problem. So the central bank may decide that maybe they should change the level at which they have the exchange rate fixed. If they decide to strengthen the fixed exchange rate, we call it a revaluation, as opposed to an appreciation, which happens in the foreign exchange markets. This is a conscious policy decision. And of course, if the exchange rate is weakened to a new level that's weaker than it was before, we call this a devaluation to distinguish it from a depreciation, which takes place in the foreign exchange markets. This is a conscious policy decision to weaken the exchange rate or the fixed exchange rate. So we just have to be a little careful with the terminology. Revaluation means strengthening a fixed exchange rate, and devaluation means weakening a fixed exchange rate. And then if you see, in order to, a revaluation can be shown by these graphs. If the government or the central bank wants to strengthen their currency by increasing the fixed exchange rate to a stronger level, one way they can do that is to sell foreign assets, lowering the money supply, shifting the AA curve to the left. And now we are committing ourselves to keep it now at this new stronger level, E2. So going forward, we announced that E2 is now the fixed exchange rate, and we have to take steps to intervene every time the exchange rate starts to deviate away from E2. Over here, as we already know, in order to weaken the domestic currency, the central bank can buy foreign assets, shifting the AA curve to the right, which pushes the exchange rate up to E2 now. And then we announce that this is the new fixed exchange rate, and we'll defend it no matter what it takes to keep it there. All right, so that's kind of the end of our discussion about fixed exchange rates. So what remains is our discussion about different exchange rate systems that have occurred throughout history, including the euro, of course. That's the most important one, I would say. So therefore, why don't we stop it right here? We'll pick it up next week with our discussion about exchange rate regimes, as they're called, especially with a focus on the euro. All right. So unless there's any last minute questions, I guess we can stop right here. All right. Okay. I'll see you all next week.
Thank you. Have a good night.
Thank you.
Good night.
Good evening.
Bye.
Thanks, Professor. Bye.
Okay. Good night.
Good night.